Hey guys, what's up, how's it going? Welcome to today's video. My name is Robin. In today's video, I'm going to be sharing with you guys 3 stocks to look out for this week in the start of November 2020. So like my last video, I'm going to try to explore some new stocks that I generally don't talk about in this channel. And in today's videos, we're going to be focusing on 2 Canadian stocks and 1 US based stock. If you guys missed my previous video that I did last week, be sure to check it out. And since these top stock pick videos are doing so well on the channel, I think I'm going to start doing them on a weekly basis. So let's jump into the video, guys. So if you guys enjoyed this video, please be sure to give it a big thumbs up. If you guys want more Canadian based and just general investing based content, be sure to subscribe to the channel. So let's get started and let's look at our first stock to buy for this week. So the first stock I'm going to be talking about today is going to be Rogers Communication. Rogers Communications is a Canadian communications and media company. It operates primarily in the fields of wireless communications, cable television, telephones, and internet connections, with significant additional telecommunications and mass media assets. Rogers is currently based out of Toronto, Canada, and was founded in 1960 by Ted Rogers. So they've basically been in operation for the past 60 years. At the time of recording this video, Rogers Communications is currently trading at $54 Canadian on the TSX. As you guys can see, over the past decade or so, Rogers has experienced quite a bit of growth actually in the past 20 years, and if we go in the past year since the pandemic happened, Rogers has slowly kind of recovered. One positive good thing about Rogers is that they are in a good position to take advantage of the 5G networks and everything switching over to 5G networks. I brought out this nice little map to see the coverage of the Rogers network, and as you guys can see, it doesn't seem like much, but this is actually one of the biggest networks when it comes to 5G networks in Canada. Most of it coming outside of Alberta, Manitoba, and then southern Ontario, and a little bit into Quebec and PEI, Nova Scotia. Rogers is Canada's largest telco, so I think they're in a pretty good position to make the transition over to the 5G networks, and they should see a nice boost in income from that as well. After reporting positive quarter 3 results, Rogers Communications stock got a nice little surge over the past week, as you guys can see here, going from $52 Canadian to $58. So anybody who's holding Rogers Communications stock got a nice little boost, although it's starting to kind of level off now since the quarter 3 results have been posted. At the time of recording this video, Rogers has 5G networks in over 130 Canadian cities and small towns. When comparing Rogers to TELUS, it looks like Rogers might be a little bit ahead of the transition to the 5G networks, but honestly, I think both of these companies are pretty good buys, and I think they're both fine picks when it comes to Canadian telecom-based stocks. If Rogers does manage to get ahead and do well with the 5G networks, that could definitely benefit them over the next couple years. Rogers Communications stock is currently a pretty solid recession-proof stock, maintaining a nice dividend yield of about 3.7%, and they should have no problem maintaining their dividend yield and even growing it into the future. Rogers Communication currently has an annual dividend of about $2 Canadian and a dividend yield of about 3.7% as mentioned earlier, and their payout ratio over the past 12 months is sitting about 63%, and based on this year's estimates, they're probably going to finish at about 50%. So this means they're paying out 50% of their profits in forms of a dividend, and this is really good. It means that they have a lot of wiggle room, and over time they have a lot of room to grow their dividend as well. So this is really good information, looks really good, and I liked the idea of Rogers Communication being a good growth-based dividend stock. So overall, I think Rogers is a great telecom stock to buy alongside other big stocks like TELUS and whatnot in Canada. So if you guys are interested in Rogers, definitely check them out. Now the second stock we're going to be talking about today is a big one, and this is Shopify. So Shopify is a pretty big and well-known Canadian company. They're a multinational e-commerce company headquartered in Ottawa, Ontario. Shopify offers online retailers payment options, marketing, shipping, and customer engagement tools to simplify the process of running an online store for all kinds of merchants. The company has reported that they have more than 1 million businesses in approximately 175 countries currently using the Shopify platform as of June 2019. The total gross merchandise volume for Shopify in 2019 exceeded 61 billion US. So Shopify is one of those Canadian stocks that really just truly keeps on growing. It's absolutely crazy, and it's probably one of the biggest stocks right now. Shopify is currently trading at a whopping $1,223 Canadian on the TSX as of right now. And as you guys can see from this graph, you can see firsthand the crazy growth that Shopify has experienced over the past couple years. So if you can manage to afford to buy Shopify, it might be something that's worth investing into. Here's some number for you guys in terms of Shopify's growth. Over the past 4 years, Shopify has grown over 2,000%. That is absolutely crazy growth. And the funny thing about the whole pandemic that we had earlier this year, the funny thing is most stocks actually didn't benefit from the pandemic, but Shopify is actually one of those rare stocks that actually did benefit because everybody is being forced to go online. So more people going online, more people need to bring their services online. So this means more business for Shopify. So Shopify actually is benefiting from the pandemic and everybody's moving to online business. Another interesting fact is since Shopify went public in 2015, they have grown on an annual growth rate of 100%. Once again, nobody could have really predicted this, but it's pretty crazy if you think about it. And the biggest reason why this is happening is simply because Shopify just keeps on growing and growing and growing. In the second quarter of 2020, Shopify grew revenue up by 97% year over year. And the funny thing about this is in the third quarter of 2020, Shopify did the exact same thing. With all the local businesses shutting down, everybody wants to get online and everybody is using Shopify to get there right now. So the big question everybody is asking right now is Shopify going to keep growing and is it going to be a good stock to buy right now? I honestly say yes to both those questions, but we got to be realistic about things. At some point in time, Shopify is going to kind of slow down its growth. I still think it's going to grow and going in the future, and if you can afford it, it might be a good growth stock to buy, but at some point in time, it is going to slow down and kind of come down to those normal growth levels. Will Shopify become the next Amazon? Maybe, but I honestly think it doesn't need to be. As long as the company keeps growing and posting high earnings reports, I think anybody who buy and invest into Shopify should do well going into the future. At the time of recording this video, Shopify does not pay a dividend as they are interested in using their dividends to grow the company, and maybe this is the reason why they've been able to have such crazy growth over the past couple years, but it would be nice to see a dividend, and maybe in the future we could see some dividends from Shopify. So let me know what you guys think in the comments. Do you think Shopify is a good stock to buy right now? Let me know. Now let's go into my third and final stock pick for this week. And with this one, I want to do something special because I've been talking a lot about Canadian stocks, and that's normally what I talk about on this channel, but I wanted to switch gears and talk about a US based stock that I normally don't talk about that much on this channel. So the US based stock that we're going to be talking about today is Realty Income. Now, Realty Income is a REIT-based stock that I haven't talked too much about this channel, but I know when I did my REIT investing case study and I buy my REITs, a lot of you guys have mentioned this stock, and it is a US-based REIT stock. So I'm going to be looking at it a little bit inside this video, and when I did this video, I actually learned a lot about this REIT, and it looks like a pretty solid REIT to invest into if you want to look at a nice US-based REIT property. Realty Income is a real estate investment trust that invests in freestanding single-tenant commercial properties in the United States, Puerto Rico, and United Kingdom. The company is organized in Maryland with its headquarters in San Diego, California. This REIT is one of the few companies in real estate trusts that pays a dividend monthly rather than quarterly and has a registered trademark phrase, the monthly dividend company. As of December 31st, 2019, the company owns 6,483 properties totaling 106 million reputable square feet with an average property size of 11,000 square feet per retail property. And the largest tenants and Realty Income include Walgreens, 7-Eleven, Dollar General, FedEx, Dollar Tree, LA Fitness, AMC Theaters, Regal Cinemas, Walmart Sam's Clubs, and Sainsbury's. At the time of recording this video, Realty Income Corp is currently trading at 59.74 USD per share. So Realty Income has been a pretty solid REIT for a long time now, and the reason why it was called the monthly dividend company is because it's paid monthly dividends consecutively for 604 months in a row. Another cool fact about Realty Income is that it increased their dividend 108 times since going public in 1994. And this shows that Realty Income has a nice solid history of monthly dividend payments that slowly increase over time. And since Realty Income has increased their dividend over the past 25 years, this actually lists them as a dividend aristocrat in case you already didn't know. Now, just like most REITs, Realty Income has faced its struggles going into 2020. But overall, when it comes to other retail-based REITs, Realty Income has actually done quite well. And like I mentioned earlier, most of Realty Income's properties come from grocery stores, drug stores, home improvement stores, and different types of retail stores such as those. And the cool thing about Realty Income is they've actually done quite a bit better than other US or even Canadian-based REITs, especially in the retail industry going through 2020. So I think they're going to do well. They've shown that they have nice, good financials, especially for a REIT. And as I show you guys, when you get to the dividend section and whatnot, I'll go show you guys some things I really like about Realty Income and why I think they're such a good REIT to invest into. So Realty Income currently has an annual dividend of about $2.81 US. Their dividend yield is sitting at about 4.71%, which is pretty low for a REIT, but it's actually a nice thing, especially in times like these. And if you look at the 3-year dividend growth rate, it says 13%. So you can divide that by 3, and that would give you about 4.5% or something like that, around 4% of an increase per year, which is pretty nice. And look at this payout ratios. This is what I like to see because of a lot of REITs have really high payout ratios, and the financials are kind of, I understand that they tend to be higher when it comes to REITs, but look at Realty Income's payout ratio saying about 80%, especially in times like these where, a lot of real estate industries are suffering right now, especially retail. Realty Income is doing a really good job with the payout ratio, and I like this conservative approach. And once again, you can see a track record of 26 years years of consecutive dividend growth with tons of monthly payments. And I think this is one of the probably the more safer REITs to invest into, but I like the fact that it's safe, and I like the fact that they actually have room for growth and they're not suffering as much as some other REITs around the world. Realty Income has purchased $1.25 billion worth of property this year and is looking to add a total of around another $2 billion in total by the end of 2020. So because of this, there is tons of room for growth going into the future, and with Realty Income, I think it's probably one of the better US-based REIT stocks to look into, and I think it's probably a good pick overall. Alright guys, so that's it for this video. Hope you guys enjoyed the video. Please let me know what you guys think in the comment section, and feel free to choose and let me know 3 stocks that you guys are buying for this month. And once again, hope you guys enjoyed these videos. Please give it a big thumbs up if you enjoy these types of videos, as I will be doing more on the channel, and let me know what you guys think in the comments, and be sure to subscribe if you guys want more videos. So thanks for joining me here today guys. Let me know what you guys think, and I'll see you guys later.